If you live in one of the coastal states right now, you are probably having a hell of a time with homeowners insurance. If you're in an area that is subject to some sort of a natural disaster, go figure, homeowners insurance don't want to cover us, and it's become very expensive and a giant pain in the ass to navigate this market. Now, I'm going to give you my insight on it, and I'm going to give you some things that I see on a daily basis that my customers are going through, and then also some of the things that they're doing to make sure that they're adequately insured, but then also properly prepared. I am not an insurance broker or an advisor. This is strictly from the lens of a mortgage professional that sees hundreds and thousands of loan applications and transactions close every year. And this is how I can help you hopefully prepare yourself. And then in the event of something chaotic happening or severely unfortunate, maybe you're a little bit better prepared, you're a little bit better insured, and you have a little bit better knowledge on how this is going to affect your mortgage, your real estate investment, and then overall maybe what the recovery could look like on something like this. So that being said, there's a couple things that we need to know right off the bat. If you have a mortgage, if you have a home loan, the mortgage company is going to require that you have adequate disaster insurance, right? Fire, if you're in a high fire area, you're going to need to carry fire insurance. If you're in a hurricane prone area, you're going to have insurance that is going to cover loss relative to the most likely disaster. Fire, wind, hurricane, flood. If you're in a flood zone, you're likely going to have to carry flood insurance as well. And that is going to be something that the mortgage company is going to force you to have. They're going to require that you go out and you find insurance to cover you in the event of these losses. And if you don't go out and find insurance to cover you, they are going to forcibly place insurance on your mortgage, and then they're going to require that you pay for it as part of your payment. Now, if you go out and you shop for your own insurance, even though the market is crazy and it's super tough and there's not a lot of options, the coverage that you're going to get is generally exponentially better than the coverage that you're going to get if the mortgage company has to force that insurance on you. It's a little crazy because I've seen it in a few instances where the mortgage company forces insurance on you and it's actually cheaper than what you can find out in the open market, but it does not cover you the same. It's only covering you for rebuilding the structure because the mortgage company or the bank is concerned only with getting the structure back there in the condition that it was in when they lent the money on it so that that asset can still be paid off through that security, through that loan instrument. They want their money to get paid back. If the house burns down and there is no insurance and the house never gets rebuilt, there is no interest on the money and they don't have the asset that they lent the money on. So they're very concerned that you carry insurance. But they're not going to cover your personal property. They're not going to cover liability if somebody gets hurt. They're not going to cover theft. They're not going to cover loss of use, right? That's a huge piece of insurance these days is loss of use coverage, meaning if your house burns down and you have to go live somewhere else and you need living expenses in order to do that because you're still paying on the mortgage even though the house isn't there, but you also have rent that you now have to pay while your house gets rebuilt. How do you pay for that? Well, there's coverage on your insurance that's going to pay for that rental, loss of use or living expenses. And that's a line item that is going to be covered on a regular traditional policy, but is not going to be covered on the forced place policy. So things to think about. We've had situations lately where people are in 30-year fixed mortgages, and because of the insurance environment in their area, they're getting canceled from their current carrier and they're going to have to go find alternative insurance, which oftentimes is more expensive. So this is to say that sometimes that can result in an increased housing expense because even though your mortgage stayed exactly the same, your insurance went up. So what I would suggest is if you get a notice of cancellation, that you would be getting out in front of it as soon as possible and start talking to as many service providers as possible, insurance service providers as possible, to get as many quotes as you can. Because the market in insurance is not like it was a year or two ago where most large companies are going to insure you and the premium may vary just a little bit, but overall you're going to get insurance that's going to be really similar. It's not that way anymore. You may talk to 5 people, 4 of them are not willing to insure you, but the 5th one is able to place a policy for you. Or maybe 4 of them are just ridiculously expensive and the 5th one is actually much more manageable. That is the environment that we're in right now. So a couple of the things when you're out there searching, let's just say you do get canceled. Many people are getting cancellation notices right now. If you do get canceled and you're going out to look for one of these alternative insurance companies or just an alternative policy, let's say, what do I need on that policy? Well, you want to make sure that a couple different things are covered. One, obviously you need to make sure your house is able to be rebuilt. So your dwelling coverage is really important. You have to make sure that the number on your policy, on that quote that they're sending you, and the reason I'm talking about this is because many people look at the policy premium, but they don't look at any of the coverages. And a lot of insurance agents aren't going to take you through each individual coverage and tell you even what the hell it means, let alone if you have enough insurance coverage. They're giving you a premium that they think works for your budget. It's your responsibility to look at it and review it, and then they're going to take your money and they're going to bind that insurance policy. You are going to be covered, but are you really covered? So the dwelling policy coverage is going to be how much money you have in order to rebuild the house. A really quick way that you can figure out if that's the right number for you to have, Google average square foot cost per construction in X area, whatever your city is, and they'll give you a cost per square foot of construction. Let's just say it's $300 a square foot right now because of cost of material and everything else. And then how many square feet is your property? And if you times the 300 by the square footage, what is that number? And then I would probably add 20, 25% to that to make sure that your dwelling coverage is at least that much. That should get you in the ballpark of making sure that you have enough dwelling coverage. If you know that because of the way your house is constructed and the projects that you've done, it's going to be more than that, you want to look at that and make sure that you're taking that into consideration. If you know, hey, based on the way my house looks, how difficult it is to build on this lot or whatever X factor your property has, you know that it's going to be more than the average per square foot to rebuild. Make sure you take that into consideration. You want to look at the personal property, how, actually replacing the things that are in your home. Things are really expensive. Everything is more expensive. Milk's more expensive, eggs are more expensive, furniture is more expensive. And in order to replace the things in your house, you want to make sure you have an accurate idea of, hey, if everything was gone tomorrow and I had to repurchase everything that I have right now as it is, how much is that going to cost me? And that should be your personal property coverage. And don't forget, you have to take into consideration things like your jewelry and other things that you wouldn't look at as just fixtures in the home. That's also considered personal property. You also want to look at your liability. If somebody comes on the property and something happens, or you're out somewhere and there's some sort of an incident, a lot of times it's your homeowner's insurance that is going to be responsible for paying those claims and protecting you and protecting your asset from being the thing that, let's say, an attorney goes after. So you want to have that liability coverage, and you want to make sure that that's a healthy amount. If you have a lot of assets and your house is very expensive, you want to make sure that you have enough liability coverage that you can cover whatever might happen where somebody might come after your homeowner's insurance. And then the other one you want to look at, obviously every line item is important. And again, talk to your insurance professional, find somebody that you trust that knows what they're doing, and you can have a more detailed conversation. But it's your loss of use, and it's going to be your personal expenses and money for your living expenses while your house is being rebuilt. How much money does that need to be? What's the rent in the area for a property that's the size that would house you and your family and your children or your animals? What would you pay in rent? And let's say in a worst case scenario, let's say there's wildfires going on like there is right now in the state of California, and there might be hundreds of houses that are in the process of getting rebuilt and getting permits and supplies and everything else. And that timeline to rebuild may take longer than normal. So how long of a time period are you going to need to account for living expenses and put a budget together that you think fits that timeline, and make sure that your loss of use or your living expenses coverage is adequate to cover that. And then the final thing that you want to look at is your deductible on the policy. This is not your auto insurance. You are not going to make a claim because you got a dent in your bumper. This is homeowners insurance. You're going to make a claim because you've had a catastrophic loss to your house, whether that is something happens on the interior and it's a major loss, it's a big ticket item, your house burns down, God forbid. That is when you're going to make a claim against your insurance. It's not going to be for every little ticky-tacky thing. So you really need to take that into consideration. How much, the larger the deductible, the more affordable the premium. So if you don't intend to use your insurance for every time some little tiny thing happens, most of us, if a repair or an expense is $1,000 or $2,000, we're not going to go pay a $500 or $1,000 deductible to do a $2,000 repair. We're just going to go and do the repair. We're going to save the policy that we have, and we're not going to make a claim on the insurance and risk getting dropped or our policy increasing. We're just going to go ahead and take care of it. So when you're looking at a homeowner's insurance policy, look through that lens and ask the agent, if I have a $1,000 deductible, what is my premium? If I have a $5,000 deductible, what is my premium? Because if you're making a claim against your homeowner's insurance, it's probably because you have a larger expense than $5,000. So you don't need to be as concerned on the policy amount because the loss is maybe less frequent than an auto, and maybe the dollar amount that you're actually going to make a claim on is going to be much larger. So make sure you look at the different options for deductibles, because it can change how much your actual policy premium is. Now, we're seeing wildfires all over the state of California. We're seeing hurricane severity increase on the East Coast. There's a lot of people that are going to be subject to some of these losses, and they're going to be navigating this process. So making sure that you are adequately insured and that you're mentally prepared for that being a reality, and maybe dealing with the system in order to get the house rebuilt is really important. The last thing you want is to reach out to that insurance provider or that insurance company and find out that you didn't have these conversations sooner, you don't have the coverages that you thought you had, or you have inadequate coverage, and now you're in a really tough spot. Not only are you stressed and are you having some significant challenges because of the possible loss of the home, now you're having some challenges and stress surrounding how you're going to rebuild, because maybe you didn't have the proper coverages in place. And unfortunately, doing this job as long as I have done it, I have seen both sides of that spectrum. I've seen people that are adequately insured and have done the due diligence and they stay on top of it and things go a certain way. And I've seen the people that are more of a bystander or a passenger in this process, and they don't take accountability for these things, and they don't take the opportunity to look at it and make sure they're prepared, and they're in a much different situation. And I can only imagine everything that's going on in the LA fires is there's a lot of people sitting in hotel rooms or in rentals or at family members' houses and thinking this exact scenario through. So hopefully this helps you guys make some better decisions. Hopefully this is some education that can save you some headache and some heartache later. If you ever have questions about how insurance premiums or the insurance market can affect real estate and mortgage scenarios, I'm always happy to help you guys through it and talk you guys through it. You can comment on this video and I'll answer, or you can reach out to the email below in the description.